Q4 2025 Economic Outlook, a balancing act of cautious optimism. The Canadian economy has weathered a turbulent storm over the past 3 quarters, marked by steep U.S. tariffs, recession fears, labor market contraction, and stalled GDP. Yet, as we stand on the precipice of the final quarter, there's a growing consensus among economists that Canada will navigate through these challenges without a hard recession. But here's where it gets intriguing. While the short-term outlook may not be rosy, with analysts predicting persistent economic pain, there's a glimmer of hope for a rebound in 2026. Before we delve into the potential turnaround, let's explore the factors that could further dampen the economy in the fourth quarter. Tariffs, rising unemployment, and sagging productivity may continue to stifle business investment and consumption, economists warn. Tiago Figueiredo, macro-strategist at Desjardins, highlights the slowing population growth and ongoing mortgage renewals, which could keep economic activity relatively muted. He acknowledges the potential boost from past rate cuts, but notes that the recent rise in global long-term interest rates is dampening their impact. Despite supportive monetary policy from the Bank of Canada, analysts anticipate sufficient headwinds to maintain a less than cheery year-end outlook. Citi economist Veronica Clark predicts further growth slowdown in the second half, with GDP averaging around flat. Labor market data for the second half of the year already indicates deceleration in job growth from trade-exposed sectors, she adds. Dawn Desjardins, chief economist at Deloitte Canada, expects consumer spending, which has remained resilient, to begin to wilt in the fourth quarter. She attributes this to the softening labor market and low confidence, which could result in weaker spending than usual for the remainder of the year. The impact of immigration caps, which resulted in negligible population growth in the second quarter, is expected to continue into 2026, according to Desjardins. This could lead to a double whammy of crimped consumption and a deteriorating labor market. With both employment and the labor force softening, the unemployment rate, which hit a recent high of 7.1% in August, is unlikely to move much higher, but labor market conditions will remain strained in the near term. Against this backdrop, Desjardins forecasts real GDP to gain 1.3% this year and 1.7% next year. However, Citi's Clark takes a contrarian view, expecting Canada's economic woes to persist into 2026 due to the slowing in demand and a widening output gap with rising unemployment. Now, let's shift our focus to the bond market, which is expected to perform well in the fourth quarter. With growth softening and inflation pressures receding, the odds are high that the Bank of Canada will continue its rate-cutting cycle. Lower and declining inflation and growth are positive for government bonds, according to Constantin Beymer, head of fixed income and portfolio manager at Mackenzie Investments. He predicts that the disinflation and weak growth trend should persist, supporting bonds. Beymer highlights the divergence between US and Canadian monetary policies, which has led to Canadian bonds outperforming US bonds, especially those under 10 years of maturity. He sees attractive opportunities for bond investors beyond the fourth quarter, through 2026, particularly in high-quality Canadian bonds and long-dated US inflation-linked bonds. Beymer is also optimistic about opportunities in local currency emerging markets, especially Mexico, Brazil, and South Africa, where real yields and policy credibility remain appealing. Turning to the Canadian dollar, Nick Rees, head of macro research at Monex Canada, forecasts a stronger year-end performance against the US dollar. His outlook is based on the expectation that the Bank of Canada will hold the rate in October, while the US Federal Reserve cuts rates at its remaining meetings this year. Rees acknowledges the risks of the Fed cutting rates too far, which could impact the US dollar to Canadian dollar exchange rate. However, he maintains a balanced view, considering the ongoing US government shutdown and the upcoming Canadian federal budget in November. Despite the potential for a stronger Canadian dollar, Rees projects that it will underwhelm against the broader G10 complex due to the economy's tight bond with the US. The review of USMCA, the Continental Free Trade Agreement, due next July, is another major risk. Rees suspects that this could prove a headwind for the Canadian dollar once the process kicks off in earnest. In terms of the Bank of Canada's policy predictions, analysts expect continued rate cuts in the fourth quarter and likely in 2026 to stimulate growth, provided inflation remains in check. Figueiredo forecasts the central bank to lower the policy rate to a trough of 2%, with the timing conditional on continued progress on core inflation measures. Clark predicts a cut in October and a policy shift indicating more cuts to follow, emphasizing the need for policymakers to remain cautious about turning too dovish. In conclusion, the Q4 2025 economic outlook presents a balancing act of cautious optimism. While the short term may bring further challenges, the potential for a rebound in 2026 offers a glimmer of hope. The bond market is expected to perform well, and the Canadian dollar may claw higher against the US dollar. However, the economy's tight bond with the US and the review of USMCA pose risks that cannot be overlooked. As we navigate these complexities, the Bank of Canada's policy decisions will play a crucial role in shaping the economic trajectory.